So this is Nathan Smith, Fresno Pacific University, continuing the slides from Chapter 9 for Economics and Business for DC students. So, all right, we were at competition in the global economy. So a key thing to think about when you're thinking about global competition is the exchange rate. So, if you're in domestic competition, everybody's using the same currency. So the currency remains at a fixed value, and people are setting their prices in the same currency, and there's no problems there. Suddenly, if you get an international competition, a foreign company's costs will be denominated in yen or in yuan or in euros or in rubles or whatever, and yours will be denominated in dollars for the most part. And if you're going to buy goods from a company in Japan or a company in China, well, which currency are you going to price that transaction in? Maybe it would be most convenient for them to price it in yen because they have yen. That's what they deal in. It would be most convenient for you to price it in dollars, but you've got to do one or the other if you're gonna negotiate a deal. So, well, of course, you can deal in foreign exchange markets. You can buy the yen in order to purchase things from Japan, or they can buy the dollars. Probably be dollars in that case. Usually, dollars is kind of a dominant vehicular currency. It's so-called worldwide, but you still need to take into account what the exchange rate is. So you can think about the exchange rate is constantly changing. It's shifted a lot. I mean, in the past, say 15 years, then the dollar has varied against the euro from like 70 euro cents to a dollar, €1.20. It's varied a lot over that period. Even though there haven't been such huge changes in the relative status of the U.S. and European economy. So in some ways it's a little bit strange that exchange rates are as volatile as they are, but that's something you need to be very aware of if you're going to be engaging in international business. So, and something that's a little counterintuitive here, so just defining terms to begin with, depreciation and appreciation, and these terms are not always used consistently in the press, but what they should mean is that depreciation is when a foreign currency, the depreciation of the domestic currency means that a foreign currency is rising in price relative to the domestic currency. So if euros become more expensive, that means the dollar is depreciating. Similarly, if euros become less expensive, then the dollar is appreciating. Now, this is a simple supply and demand model with one extra detail which turns it into an international trade model. The extra detail is that we call dx, sx, these are the domestic demand and supply of some good x, and SF is the foreign supply. So what happens? Totally different than what would happen if it was a closed market. If you had a closed market, what would happen? You'd end up at E. So that's where supply and demand intersect. Quantity demanded is equal to quantity supplied. The price moves to set them equal. You end up at E. Okay. What happens when you have foreign trade? Well, we're assuming here that the global supply is available in unlimited quantities at a price of 3. Why do we say unlimited quantities? Well, we're sort of implicitly assuming that this economy that we're dealing with is small. So it's probably not the United States, although for some purposes even the United States would be small. But certainly, particularly if you're Sweden or Ireland or something like that, your domestic demand is not going to have much effect on world demand. Anyway, you see that this is flat, and this just says the world can supply any unlimited quantity at this price of 3. Or at least for domestic purposes, we won't really be able to affect the market price at all. So, what do you get? Well, some of these suppliers actually have costs that are lower than 3, so these suppliers would be willing to supply the market. But many of the suppliers who would operate if you just have the domestic market will get knocked out, and instead you'll get foreign trade. Well, why in the world would we let this happen? Why would we allow all these suppliers to be driven out of the marketplace by these cheaper foreign competitors? And moreover, even these guys lose profits because they can't sell it by as much as they could. Why would we let that happen? Well, look at what consumers get out of it. They buy more, they get it for a lower price. So this is good for consumers, and it's actually better for consumers than consumers gain more than suppliers lose. So that's why economists are pretty strong supporters of free trade, generally speaking. Okay. So this portrays foreign exchange markets, and you can think of foreign exchange markets in supply and demand terms too. So where does demand for euros come from? Well, it comes from tourists. It comes from businesses who want to buy goods from Europe, from students who want to study in Europe. So these would all be people who would demand euros. It would come from businesses in the U.S. who earned profits in dollars and want to repatriate those profits and pay them out as dividends to shareholders in euro area countries. So this is all where demand for euros comes from. What about supply of euros? Well, it's the exact opposite. I mean, it's students who are European students studying in the United States, European tourists in the United States. It would be European companies that want to buy American goods, and so forth. So, well, there will be some supply of euros, some demand for euros, and there will be some equilibrium point at which those are equal to each other. And it's interesting that the amount of money traded in this market on a daily basis is just huge. It's like many trillions of dollars, and a lot of it's actually driven by speculators. So there's more to foreign exchange markets than is shown here, but that gives you a general idea kind of how foreign exchange markets are determined. So this shows foreign exchange quotations as of some particular day. You notice the annual changes are rather small because they picked January 11th, so there wasn't very much time for the prices to have moved. But actually, even in spite of it just being 11 days, Australian dollar has appreciated. So you've got 2% movements, or that's actually indicative, can have significant. And this wasn't a particularly crisis period. This is just kind of the normal fluctuations there. So they're substantial. So you notice that all the European currencies seem to be kind of moving together relative to the dollar. But the other point here is how to read them. So the Argentine peso, for example, what's it worth in U.S. dollars? It's worth 25 cents. How many pesos does it take to buy a dollar? So per U.S. dollar, $3.97. This is just the reciprocal of that, 1 divided by that. And so in every case, this is a reciprocal relationship. There's 1.0068, 9932, and so on. And anyway, so those foreign exchange quotations. Okay, now, and why did we talk about competition in the global economy immediately after the perfect competition section? Well, because most of the time this competition will be of a pretty competitive nature. I think particularly global markets tend to free trade tends to make the domestic market more competitive because it gives you more competitors when you're also competing with foreign firms as well as domestic firms. So those are somewhat connected. Okay. Monopoly. So in monopoly, you have a single seller, no close substitute for the products they're producing. So why would this be the case? Well, we mentioned these earlier actually, but so controlling a resource, it could be because of patents, it could be because of natural monopoly. I think cement is another example of this actually. Cement, there's large economies of scale, and you can't distribute it very far, so usually there will be a natural cement monopolist in each region. government franchises like the post office. Okay, so short-run equilibrium for monopoly, and yeah, we economists, we love talking about equilibrium. This is actually sort of more like profit maximization in a way. I mean, it is I guess it's an equilibrium too, but it's not equilibrium in the same sense that we usually talk about with demand and supply curve. Notice we talk about we talk about a demand curve here, but not about a supply curve. The concept of a supply curve doesn't really make sense in monopoly markets, so that's a difference. The demand curve for the firm is the market demand curve. Remember, we made a distinction earlier between the market demand curve and the firm demand curve. And in the case of perfect competition, there's a very dramatic distinction because the market demand curve will be downward sloping, like what we're used to, but the firm demand curve is horizontal. But in the case of a monopolist, the demand curve is also downward sloping. So, and in fact, some of this monopoly analysis applies to any firm with a downward sloping demand curve that faces a downward sloping demand curve. That's one reason why it's useful to study monopoly, even though it isn't that common, because it can, some of the same analysis cross applies to other situations that aren't completely monopolistic. Okay, so the firm produces a quantity Q star, and it's going to set marginal revenue equal to marginal cost, which is the same thing that firms are always doing. The difference here is the marginal revenue curve is not the same as the demand curve as it was in perfect competition. If average variable cost is above the demand curve at all levels, then the monopolist won't produce anything. So it's sort of a special case. I mean, this is sort of it's kind of a self-defeating special case because then it just won't be a market. Nobody will produce it because it can't be produced at a price that covers costs. But you can think about like a disco club in a small town. Maybe whatever price they set, they're never going to be able to cover their costs if the town's too small to support a disco club or a sushi restaurant or something. Anyway, okay, so here we see rather complicated chart here, but I'll explain it. Start with the demand curve. Notice the demand curve is downward sloping, as we just said. That's the characteristic of monopoly, downward sloping demand curve. Marginal revenue is twice as steep. This is this kind of special feature of linear demand curves, that their marginal revenue curve is twice as steep. It's not very realistic, but it's analytically convenient. It serves our purposes just fine. So then we have the marginal cost curve. Marginal cost curve slopes up. This is just an assumption about the fundamental nature of the technology. Average total cost. Well, I guess it initially slopes down, then slopes up. The reason it slopes down is because there's some fixed costs that are being spread out over more units. And so where does the monopolist set revenue? At marginal cost equals marginal revenue. This point, E. And in this case, they're able to make some profit because everything that's above the average total cost curve and under the price curve, that's profit. So that's what we call short-run equilibrium. Long-run equilibrium, honestly, it's pretty similar. I mean, so we've drawn the long-run marginal cost intersects marginal revenue. Notice that the demand curve is the same, so no difference there. We're not assuming any changes in demand. We're just assuming that the monopolist has time to adjust supply. So, in this case, then it's been drawn so that the monopolist is able to expand production relative to, previously he was producing only quantity equals 500, and now he moves it out to 700, because when he has more time, then he's able to increase his capital stock and produce more efficiently. So you see you have the short-run marginal cost is steeper than long-run marginal cost, because long-run marginal cost means that you have time to adjust your input mix. So you've got long run average cost, short run average total cost. Again, long run average cost, this envelope is on the outside of short run average total cost. And so then you see he's actually making even more profits in the long run than he was in the short run. How much was he making in the short run? So 500 times 3, $1,500. Now he's making 700 times 4, $2,800. Okay. So, now, why do we usually think of monopoly as bad? Actually, it's an interesting question in general. I think with ordinary people, they might just think it's kind of unfair, or they might think that you're not getting that much choice, or maybe it's just like the desire to take down the one big guy. I don't know. But from an economist's point of view, we think about this inefficiency. So when we look at this, we say, okay, the price is higher. Is that bad? Well, not entirely, because that means the customer has to pay more, but it also means that the monopolist earns more. So, not so terrible. The consumer's surplus is reduced. Well, what would the consumer surplus have been? Consumer surplus would have gone all the way out to here. So remember, consumer surplus is the extra value that consumers get over and above what they have to pay, and the value they get is indicated by the demand curve. So everything that's under the demand curve and above the price line, that's consumer surplus. So previously it was this whole area, the big triangle. Now it's this G and E, which was previously consumer surplus. Now it's GTH. So that's been reduced a lot. Now some of that, this rectangle TNE prime H, this goes to the monopolist. So some of the former consumer surplus goes to the monopolist, but notice this triangle HE prime E. This is just lost. The consumer doesn't get it, but the monopolist doesn't get it either, because these goods just don't get sold at all, even though they're worth making, in the sense that the value that people place on them is lower than the cost of making them. So, so in this case, then this is called a deadweight loss. This could be called a social loss or an efficiency loss. It's basically nobody gains. It's just lost to society as a whole. And this is the main reason why economists don't like monopoly, because it's inefficient. Not so much any kind of fairness concern or anything like that. Although maybe you could bring that in if you wanted to. So now we talk about monopolistic competition. Again, this is kind of a paradox. So we have many sellers of differentiated products. What does differentiated products mean in practice? It means your demand curve is downward sloping. Because if you raise your price, you don't lose your whole market, because some people prefer your brand. If you lower your price, you can increase your market somewhat, but you can't take over the entire market, because some people prefer other brands. So you have a certain kind of monopoly power. We call it a limited monopoly power. And competition actually comes in here too. It comes in and it eliminates your profits, as in perfect competition, but it does it in a little bit of a different way. And so this should become clearer as we look at it graphically. Okay, so monopolistic competition, downward sloping demand curve. It's drawn here as a little bit less downward sloping than the monopoly case, but that's not really essential. Marginal revenue is steeper than demand for the same reason. If you want to sell more, you got to lower your price. That lowers your revenue on every previous unit. Therefore, the extra revenue you get is smaller than the price that you charge on the last unit. So, again, if you're maximizing profits, you find the place where marginal revenue equals marginal cost, and in this case, then you can still earn some profit. So, average total cost lower than demand, you can still earn some profit. Okay, but now what happens in the long run? Well, in the long run, the idea is that even though the products are differentiated, then new firms can always move into this industry with new brands, and they'll tend to reduce the demand for your product. So notice D prime, this is to indicate that D has moved relative to the previous chart. There's a new demand curve. And this is a very particular kind of demand curve, is it's drawn so that it is tangent to long run average cost. So this is crucial, this point of tangency. So why does that matter? Well, why does it occur and why does it matter? The reason it matters, is sort of the significance of it, is that this eliminates profits. Why does it occur? Because entry continues until profits have been eliminated. By profits here I mean economic profits. So not ordinary payments on capital, but extra profits that come to the entrepreneur. If there are any economic profits, that will attract entrants. Entrants come into the market. They reduce demand for your product. They keep pushing demand for your product down until it intersects the long-run average cost curve. And they'll have similar demand curves. And that's why, at this point, no more entry will occur. So demand won't get pushed down any further. Because at this point, nobody's making any profits in the industry. Everybody's like this, where they can only break even by producing this exact amount. You notice, if you produce Q equals 4, sell for price equals 6, then you can, your long run average costs are 6, your price is 6, so you can cover your costs. If you produce more, you can't cover your costs because long run, your demand for your product falls and long run average costs don't fall as much. If you produce less, long run average costs are higher than demand as well. This is the only place where your firm can even break even. You could say, well, what's the point of staying in the industry if you get no economic profits? Well, maybe the economic profits are a tiny bit, slight economic profits, but it's not enough to be worth anyone else's while to enter the industry. And so then this is the monopolistically competitive outcome. So you notice how competition has been brought in. It's been brought in a different way. It's been brought in by the whole demand curve moving down rather than just the demand curve being horizontal to begin with. And this seems realistic for a lot of firms. I mean, it's not very realistic to think of McDonald's as being in perfect competition, so that if they were to raise their price by a quarter, raise the price of a Big Mac by a quarter, then all demand for McDonald's would disappear. Everybody would go to Burger King. No, that's surely not true. But it may. But on the other hand, they'll have a lot of overhead costs, and so it may be that they tend to get pushed down to where they're not really making any extra profits because they're in this monopolistic competition. This is a little bit of a modification. They assume selling expenses, so they distinguish long run average cost and then long run average cost star, which includes selling expenses. And then the idea here is that, well, if all firms have to incur selling expenses, which means like advertising and extra deliberate product differentiation. Some people think product differentiation is inefficient. This is actually an interesting debate about whether is there a lot of sort of wasteful diversification of products, or is there value in having all these different brands out there? But we won't get into that in detail. But the assumption here is just you've got some selling expenses, and so firms get pushed not down here to where they're only covering their long, but down to this point where they're covering their average cost plus their selling expenses. So that's a little bit of a variation on the monopolistic competition model. So that's probably enough for now. This stuff gets a little bit too complicated. So okay, that's it for chapter 9.